Okay, great. Well, good afternoon, everyone. I'm Linda Knowlton, your FAMP president, and we have a very informative and exciting webinar today with one of our wonderful, wonderful industry partners, Freedom Mortgage Wholesale. We have three of their superstars that are going to be part of us today, and give you all the information that you need for the VA cash out. I am going to turn it over to Ken Slow, who's the corporate trainer, senior corporate trainer for Freedom, but this will be recorded and we have lots of times for questions, and Ken will be monitoring the chat room, so type in the questions as we are going through the presentation, and they will just answer any and all information that you have. So without further ado, I am going to turn it over to Ken, and he's going to introduce Lance and Kathy. So Ken, take it away.
Thank you so much, ma'am. It's great to be with you today to talk about Freedom's VA Cash Out program. Along with me today is Lance Lay. He is one of our best Freedom account executives located in Florida. He's in the Clearwater area. He has over 17 years of experience in the mortgage industry, and he's been with us for 8. And he is going to certainly give you the sales perspective on these products. And also Kathy Holler. She's our underwriting manager and our ace VA underwriter for sure. She's been with us for many years, and she is in Pennsylvania, so maybe a little bit colder for her than it is for us. And she's going to be along to help answer any questions that you may have, and also talk about some particular points along the way here. So as Linda was saying, you will be receiving an email from us, from FAMP, with a link to a recording of this call, and also the actual PowerPoint that we are using on the call. So any of the information that you see me referring to, you'll know that you're going to be getting that as well. We have some charts and things like that that you probably want to refer to as we go along, and you will have access to all of that information. So with all that said, let's go ahead and get started. And we certainly do want this presentation to be valuable, not just for you folks who have possibly been doing VA business for some time, but also for those of you who are maybe just sticking a toe into the VA waters, so to speak. So we are going to definitely answer some basic questions, and we will have plenty of information about the way that Freedom does the product, which is a little bit different and a little bit better than other folks do it. So today we are going to cover benefits and selling points, our VA cash out refinance types, meeting the net tangible benefit requirements, key program features, program parameter specifics, credit and underwriting requirements, loan processing guidance, and some frequently asked questions. And with that, I'm going to ask Mr. Lay to come in here and help us kick things off by speaking about the benefits and selling points. So Lance, if you would, please.
Yeah, thanks, Ken. So first we'll talk about the selling points. Why would someone want to do a cash out refinance in the first place, right? You've got to start there. So home improvement is a very popular choice, remodel the kitchen, put in a pool, new floors. Anytime someone wants to upgrade the home, a good way to get the cash for that is through a cash out refi, of course. College tuition is another idea. I personally have a daughter at Florida State right now, so I can confirm that's not cheap. So tapping into your home equity to help them if you need to, so they don't need student loans, is a good idea. Retirement reinvestment. So you can borrow right now, ballparkish 3% at cash out refi and VA. And if you can reinvest that in a vehicle that's going to give you, somewhere between 8 and 10% a year, that means you're going to net, 5 to 7%, maybe speed up retirement a little bit. So if you have a, financially savvy borrower that's talking about things like that, that could be a good idea for them. And then other uses, it says new car. I'm not a big fan of taking an appreciating asset and buying a depreciating asset with it. But some people they might have the keep up with the Joneses type thing, may want to do that. The big ones here for me are down payment on another home. So you want to buy an investment property and put 20% down, or buy a second home, put 10% down, or, maybe you're moving, you want to avoid having mortgage insurance, you don't want to sell the house, you can do the cash out refi and use the money to purchase the other home. And of course, emergencies, unexpected expenses, always good to have some backup for that. Then go to the next slide here. So then there's two types of VA cash out refinances. There's type 1 and type 2. When this came out, we had that cash out form, which you guys, we still need to still fill out. It kind of confused a lot of people, like what's the difference between 1 and 2, and when am I doing a 1, when am I doing a 2? The reality is in Florida, you will almost never do a 1. The type 1 cash out refinance, the loan amount can only be equal to the payoff, and that has to include the funding fee. So the borrower would have to bring to the table all their closing costs and also the equal amount of the funding fee that, of course, they're not going to be able to pay with the loan, since that's going to be taking out part of that payoff. So it's not a very attractive option. They're going to have to come to the table with a lot of money. However, as I'll talk about here in Texas, they only allow type 1. So they may have created the type 1 just to get past that Texas cash out rule. But type 2 is what you're pretty much going to be doing all the time, especially if you don't lend in Texas. This one, you can, roll in closing costs, put in the funding fee. You can take cash out or not take cash out. Now, also a fact about that, if you don't take cash out, it's still considered a cash out refi with VA. So if you roll your closing costs in, roll the funding fee in, but take no cash, so in the conventional world, you would consider that a rate and term, VA still calls that a cash out even when they don't take cash. The only non-cash out refi in the VA world is a IRRRL, interest rate reduction loan. And then we have to hit net tangible benefits. So some people thought for a while, again, when this initially came out, that these only applied to interest rate reduction loans where they had to do the 36-month recoup, if you guys are familiar with that. But the cash outs actually do have a set of net tangible benefits. The easiest one to hit is, if your LTV is under 90%, including your funding fee, you're good to go. You don't have to meet any other net tangible benefits. You're automatically considered to be a benefit if you're 90% or below. Now, in the event where your borrower does want to go over 90%, they want to take advantage of the full 100% cash out that the VA offers, then you have to hit at least one of these other net tangible benefits. So they have to either be reducing the term, so taking from 30 to 20 or something like that. You have to be lowering their principal and interest payment by any amount. It just has to go down, or be lowering the rate by any amount. It has to go down. And then this next one's kind of a cool little trick to keep in the back of your pocket. So if you have a borrower who wants to go to 100%, take the full cash out, they don't reduce the term, so they're going 30 to 30, 30 years. Their P&I is actually going up because they're taking so much cash. And since we're in a little bit of an increasing rate environment right now, let's say the rate goes up an eighth, so they don't hit any of those top three, you can still do it by increasing the residual income by paying off debt. So they can roll in a credit card, installment loan, a vehicle debt into that cash out, and now they can move forward as their net tangible benefit. So that's kind of a cool, little trick in your back pocket there. You can also, it's considered a net tangible benefit if you're refinancing out of a construction to perm loan. So if you're doing the permanent loan VA and paying off that construction loan, that's okay always on these. If you're going from an ARM to a fixed, that would be considered a net tangible benefit. Or if you're currently in an FHA or conventional loan and you have mortgage insurance, and you're now not going to have mortgage insurance because you're going to a VA loan, that's also a net tangible benefit.
Thank you very much, Lance. Appreciate that.
One too, or?
Oh yeah, go ahead. That's right. I'm sorry, you're ahead of me.
Gave me this extra responsibility here.
That's right. That's right. Thank you.
No, you got it. So we're on the key features. So like I've mentioned a couple of times, you can go to 100% LTV on this. It's the only cash out product that goes that high, which is a pretty cool feature. The funding fee is a one-time fee, and there's no mortgage insurance on VA loans. So that's a cool feature that they have. They're not having that mortgage insurance. If you have a disabled veteran who's more than 10% disabled, then they don't even have to pay a funding fee. So that's pretty cool. Other things to keep in mind, this is for owner occupied only. So if you have a veteran, let's say they were stationed in North Carolina and bought a home there, VA, then they got relocated to Jacksonville and bought another home there, VA, when they got relocated, but they retained that home up in North Carolina. So they have two VA loans. they can only do a cash out on the one they're occupying. So they can only cash out the one in Jacksonville. They do have an IRRRL option if they wanted to just lower the rate on the one in North Carolina, but they could not take cash. There is a rate hit on these over 90%. So if you go over 90%, including the funding fee, we have a 2-point adjustment on the LLPA. I believe a lot of our competitors do also. That kind of keeps people under 90% naturally. So when we go back to that net tangible benefit page I went into, a lot of times, you're going to automatically hit net tangible because that rate hit's going to keep you under 90 anyway. Your veteran and your spouse are the only ones allowed on title. So you can have 2 veterans, a veteran and a spouse, but you can't have like a fiance or a friend or something on title on these with you when you refi out. If it's a condo, it has to be on the condo approved list for VA. To find that list, you literally just Google VA approved condo list, and it's the very top link. So that's the tool I use all the time to send to my accounts. If they say, hey, is this approved? And just Google it real quick. It's the very top link. You can send it to them. I mean, you can use it yourself or send it to a realtor that's talking to you that wants it. It's very easy to use. That would be in a situation, obviously, if they're currently in a VA loan in a condo, then it's probably going to be on the approved list. But if they're currently in a conventional loan in a condo and they're trying to refi VA, there's a chance it won't be on the approved list. So you got to make sure to check that. And then some specific guidelines. We do not have a max loan amount. So, I mean, we can literally go 10 million, whatever, just think of a crazy number. We can do it. We don't have a limit. We're 580 score and up. So, anything 580 and up. No max DTI with us. So as long as you have an AUS approval, which I've seen on VA that very high, 70% sometimes if they have good credit and residual and assets, we will do it. We do have some residual income overlays once you get over 50. So just make sure you talk to your AE on those, but we do those loans no matter how high the DTI is. We also offer manual underwriting. We do not add any payments on collections or charge-offs. So like FHA makes you add the 5% on VA. We don't ever add any additional payments for collections or charge-offs. We restore entitlement for you. So on the refis, if they're paying off another VA loan, we will restore their entitlement on their certificate of eligibility. So in the future, when they go to use it, it's nice and clean the way it should be. We also do that on purchases. If they're selling one home, buying another, we will restore that for them also. And we don't have any LLPAs, so no rate hits for high DTI or manual underwrite. So I think some of our competitors do hit you maybe a quarter if they're doing a manual underwrite or something for over 50% DTI, but we don't have any adjustments for either of those.
All right. Thank you very much, Lance. Appreciate that. All right. Lance is going to be around along with Kathy at the end, and we will take your questions. So feel free to get those in the chat box. Looks like they are starting to come in here. All right. So let's start talking about some program parameter specifics, especially the VA loan limits, as Lance was referring to. So the VA conforming loan amounts, they follow the traditional conforming loan limits. So for 2022, that means it's $647,200 for a conforming 1-unit property. And if you are in a high cost designated county, that can be as much as $970,800 for 1 unit. And the VA jumbo loan amounts, any loan amount over the conforming loan limit is available to 100% LTV. You may include any VA funding fee required if the required net tangible benefit is met. No MI, one-time VA funding fee at closing. We'll talk about that here in just a couple slides if that is new to you, the way VA handles mortgage insurance. And Freedom Mortgage has no jumbo overlays or maximum loan amounts, again, as Lance was mentioning. However, if you do have a loan amount exceeding $1 million with a 100% LTV, there will be some additional due diligence by Kathy and her folks in underwriting. Okay, so this page is kind of dedicated to those of you who may be just beginning your VA business here. And we want to give you the basics here. We want to help you get that up and rolling here. So it's important to remember that VA doesn't lend directly, but provides a financial guarantee of 25% for loans originated by companies like Freedom. The VA funding fee is charged up front. This is the VA's version of mortgage insurance, but it is a one-time fee, and it takes the place of other forms of mortgage insurance found with other types of loans. So it is normally just financed into the loan. The veteran can pay it if they want at closing, but it's normally just financed. And again, it does take the place of those monthly MI payments. So the guarantee is reflected in a dollar amount referred to as the entitlement. Very important term there in VA language. The borrower's amount of entitlement really determines how much they may borrow. That calculation is determined by the information on the borrower's certificate of eligibility, or the COE, a very central document here in VA, and we're going to show you how to order that here in just a little bit. And if the borrower only has one VA loan today on the subject property when the loan is paid off via refinance, the borrower will be presumed to have full entitlement. If the borrower has used a portion of their entitlement on another property other than the subject property for this refinance, they will have less than full entitlement there. So there's kind of first time use of the entitlement, and there is a subsequent use. That's normally the way that it is referred to. Okay, so determining the required VA funding fee works pretty much like this. For the first time use of the entitlement, it is 2.3%. For all subsequent uses after that, it is 3.6%. And there are some folks here who are exempt from any amount of VA funding fee. Those are veterans who were injured while in service, and they receive a disability compensation or have a disability rating of 10% or higher. Surviving spouses of veterans who died in the line of duty are also exempt. And then also those veterans who have been awarded the Purple Heart are exempt as well. They present documentation to that effect, and they will have no funding fee liability there either. Now, VA does require a residual income calculation, meaning the amount of money that they have left over after all of these particular points here are subtracted from their gross income. So again, we begin there with their gross monthly income, and you will subtract federal, state, and Social Security withholdings. Then you will subtract their monthly obligation, which includes child care for children 12 and under. There is a child care letter that is required for those circumstances. And then the maintenance expense will be subtracted, and that's calculated at 14 cents per square foot of the subject property. And then finally, the full PITI mortgage payment is also subtracted, and what is left is what we refer to as the residual income. And depending on the family size and where the home is located, the veteran does have to have a required residual income amount. So there are two different tables here, one for loan amounts of $80,000 or greater, and one for $79,999 and below. So let's say that we have a family size of 3. And Florida, each one of these 4 groups contain a number of states. You can check on the states down here, but Florida is in the South, which does make sense. And for a family of 3, after all this calculation is done, the veteran must have at least $889 remaining for a loan of $80,000 or above. And then for a loan below that $80,000 mark, that same family of 3 would need residual income of $772 or greater. So again, you're going to have access to all of this information when we send you the PowerPoint. Okay, now here's the one that I always love, the mandatory seasoning requirements. I'm going to try to make this simple, but we're going to get a little help understanding it as well. So borrowers must have made a minimum of 6 months of mortgage payments on the loan being refinanced, beginning with the date on which the first payment was due. That's number 1. And they must have made 6 consecutive payments, made those on time. And the new note date must be at least 210 days, and keep your eye on that figure. It's kind of a key number, the 210 days, from first payment date on the loan being refinanced. So mandatory seasoning requirements apply to any loan type, including payoff of an existing conventional loan. And then for loans being paid off that were originated within 1 year from the original date of closing, the loan file must include a payment history or ledger from the loan's servicing company documenting all payments, making sure that they were made on time. So those are the regular mandatory seasoning requirements. Now we of course throw in seasoning and forbearance under the CARES Act, which is kind of another layer of requirements here. So if the borrower had a period of forbearance, they cannot count this time toward the seasoning requirements. However, forbearance under the CARES Act does not alone cause the loan to fail to meet this standard. So seasoning requirements met prior to forbearance. So if they made their 6 consecutive monthly payments on time prior to going into forbearance, they have met the seasoning requirement. And seasoning requirements not met prior to forbearance means that if the borrower made 5 or less consecutive payments before invoking the CARES Act, the borrower would need to make the 6 additional on-time payments post-forbearance in order to meet the seasoning requirement. And the credit report payoff, if there is indication on the credit report or payoff that the borrower has previously been in a COVID-19 forbearance, the payment history must be obtained from the servicer to make sure that all the on-time payments and months were satisfied there. The loan must be current. Loans meeting the seasoning requirements must be paid up to date. And then some implications for loans brought up to date via loan modification. So after forbearance, if the loan has been brought current using modification, the seasoning requirement is then 210 days. So the clock starts again from the first payment due date on the modification. And to clarify, if the loan has been modified, even if seasoning was met before the forbearance, the seasoning period starts over from the date of the first payment under the modified terms. Simple to remember, right? No problems there. I'd like to invite Kathy Holler in now to point out any errors that I might have made there and give us some additional insight on the seasoning requirements. Kathy, if you would, please.
Good afternoon, Ken. Good afternoon, everyone. Ken, you did a marvelous job going over all of the requirements as far as the seasoning. Instances where a borrower has been in forbearance or the loan has been modified. So those are really key items to look at. A lot of times your borrower may not divulge that information immediately because they know that they're current on the loan. So what I would suggest when you're doing your first interview is to, when you have the credit report in front of you, is to look at the trended data because that will give you a definite clue if your borrower has been in forbearance and or the loan has been modified. So again, just keep in mind the seasoning requirements that must be met regarding whether it was a forbearance or a modification. I'd keep this little slide that Ken has prepared for you. Keep it handy because it will come in very helpful at each interview.
All right. Thank you so much, Kathy. And Kathy's going to be with us a little bit later on when we do take your questions. So feel free to put those in the chat box again. Okay, so let's talk about everybody's favorite VA website, VA mortgage website, and it is commonly nicknamed as the WebLG website. And the actual portal is at www.lgy.va.gov. This is where you go to order all of the documentation, the VA documentation that is necessary for the loan. When you do get this PowerPoint, you can click this link right here, and that will take you into the VA's user guide. which explains how to do all these different functions in more detail. And they also have some videos there that should help you along as well. So what is it that you need to order? Again, we're kind of appealing here to those of you who may be just starting out in this line here. So what are the things that you need to order on that WebLG website? Well, first of all, you need to order a case number. That's number one. And it's important, of course, to follow these steps in the order that we're laying them out. So we order the case number, and then you can obtain the certificate of eligibility, the COE. And you always order a new COE for each loan that is specific to the loan transaction type. Now, the COE can be accessed by using at least two of the required data points in the system. That is the reference number, case number, and the veteran's social security number. So not difficult to do there. When you are ordering the COE, it is very important that the form below is completed accurately. And this is the form that we're talking about. Again, that's on the website there, to specifically obtain a cash out refinance COE. So there are purchase COEs and there are cash out COEs, and I believe there's one for the Earl as well. So we want to make sure that we are doing the one for the cash out refinance. And then once that's obtained, once you've got a hold of that, an additional or updated COE does not need to be obtained or updated unless it is required by a Freedom underwriter there. All right. And then also the next important thing that you would be doing there is you would be ordering the appraisal from the VA's website. This works just exactly the way you would order an appraisal on any other type of loan as with respect to the timing. So this would be after you had issued the intent to proceed, of course, and once the intent to proceed has been received, then of course you may go ahead and order the appraisal. And of course that would be after the COE is obtained there. Now, there are two different ways to order the appraisal, and it is important here that you do this in the correct order. So we want you to order it under the LAP, or LOP if you're a little bit more sophisticated, which is the Lender Appraisal Processing Program. There's also another way to do it, and that is through the NOV, Notice of Value. What we would like for you to do and really urge you to do is to order this through the LAP process. That means that Freedom then will be able to issue that notice of value, and we won't be waiting for the VA to do that. When you do it in this order, then things are going to move more quickly, and you're going to get closed faster. So again, the important thing to remember there is to order it under the LAP process. And of course, the appraisal invoice must be paid by you as the client within 5 days of receipt of the appraisal. That is a VA regulation. Okay, so now as we're beginning to kind of wrap things up here, let's get to some frequently asked questions. And I believe as Lance did mention earlier, there are manual underwriting options. Those are for loans receiving a refer eligible, provided the maximum DTI ratio of up to 43% is satisfied. So manual underwriting is possible there. And this next section, I believe, is very advantageous for you, especially if you have been doing a VA business for a little while. Previously, a National Guardsman had to have served for 6 years in order to get the VA benefit. And in December 2020, the Veterans Healthcare and Benefits Improvement Act changed all that. So now, if a guardsman has been, guardsman or guardswomen, I don't know if they have a gender neutral term on that one, but meaning anyone there, mobilized under Title 32, which is by order of the governor. If the governor had, sent them out, all they have to do to have this VA eligibility is to have served 90 days of full-time duty, provided at least 30 days of those were consecutive. And this change is retroactive. So again, if you've been in this game a little while before and you've spoken to folks in the Guard, they may have said, I would love to do a VA loan, but I don't have 6 years of eligibility. Well, now, since this is retroactive, going back to just about as old as anybody could be, and still have been a retired guardsman, they now are going to qualify for as long as far as the eligibility of 6 years requirement. That has now been reduced greatly. So you may have an entirely new pool of people to go back to if you've gotten in your tickler file, and you can go back and now speak to them, and they probably don't know that this has happened, and it could be a tremendous benefit for them. And again, I give you an entirely new pool of eligible borrowers there. Also, what are the water test requirements? Well, there was a COVID-related VA flexibility, and that has been disconnected. I'm discontinued, rather. I was thinking about water being disconnected there. Temporary allowance providing for exterior only appraisals and not requiring a water inspection test has been reversed. So water tests will have to be done, and that will have to be done by a disinterested third party. Also, borrowers are not required to hook up to public water if available when it is not required by the municipality. And then finally, my last one is the termite inspection required. Yes, it is always required in moderate to heavy tip zones. This may be a new term for you. I kind of love it myself. I have a little too much fun with it probably. But the tip zone is considered the termite infestation probability zone. And you can see over here by the map, all of Florida is in the very heavy infestation probability zone area. So this is going to be required. All right. So if you are not currently a Freedom client, and you've kind of been kicking the tires and deciding, well, maybe it is time that I became a client of Freedom Mortgage, there's never been a better time, because now we are waiving the $110 application fee in co-emergence, and that is going to run through March 31st. So you've still got almost 60 days. We'd love to have you apply to become one of our clients. And to sweeten the deal a little bit more, we are offering a 1/4 point price incentive, and that's going to be eligible for a wide range of our conventional and government products. And that price incentive will be in effect for the first 60 days of your registration with us. So from your effective date, it will be 60 days that you will be getting that price incentive. So now is really the time to become one of our clients. We would definitely love to have you. Also, if you'd like to just learn a little bit more about what you've seen here, you can contact your account executive or email us at askfreedom@freedomwholesale.com. And again, if you are interested in becoming a client with us, you can go to freedomwholesale.com/wholesale/become a client. And that's where you can take advantage of the $110 fee being waived and the pricing incentive. So I do, at this point, definitely want to invite everyone to continue to put your chat questions in. And while you're doing that, I'm going to ask Kathy to come back and talk about some of the most common errors that she sees when processing the VA cash out loans. Kathy?
Thanks, Ken. What I have seen to be the most item that is overlooked at the time that the file is submitted for underwriting review is that the application itself isn't fully completed, where in regards to the number of dependents and the age of the dependents that the veteran has in the household. As Ken pointed out on an earlier slide, we do have to determine residual income. And in order to do that, the number of dependents in a household weighs into that heavily. So if oftentimes we don't find that there's any dependents reported on the application, but when we are reviewing the pay stub, we do see that there is child insurance or other items that would lead us to show that there is more than just the veteran in the household. So that's one of the biggest items that it seems to be overlooked when the application is taking place. The other item is the COE is not obtained for a refinance transaction. So when you're ordering that through the WebLGY site, please make sure that you are requesting the certificate of eligibility for refinance. Those are the two main items that do slow us down when the file comes into underwriting.
Okay, fantastic. Thank you, Kathy. And we do have some questions here. So Mercedes is asking, is it still full entitlement if they are refinancing the original loan?
Yes.
Okay, great. And Nellie has one here. If they are buying a duplex to live in one side and rent out the other side, is this an allowable property?
Yes, it would be, as long as one of the units is owner occupied, that is an acceptable property.
All right. And let's see, Mercedes has another question. If a vet has met the seasoning and was in forbearance, but the balance for the forbearance months was added as a second lien on the title, do they have to meet the 210 days or just 90 days?
After coming out of forbearance, if the loan was not modified and they just did a second lien for that for those skipped payments, you don't have to meet the 210 days for that lien.
Okay. All right. And then one more here. If there is a non-borrowing spouse, do they need to include them on the credit report?
If the property is located in a community property state, we would need that non-borrowing spouse's credit report.
Okay. All right. Well, we'll give you just another second here. If you would like to put a question in the chat box, that's all we have right here. Well, and Nellie and Mercedes, you're very, very welcome. Thank you for your input here. And if we don't have anything else, then I'm just going to give this back to Linda. Linda, if you want to
finish
things out.
Absolutely. Absolutely. And just keep an eye on that chat in case box, in case we get some last minute questions that come in. But this was very, very informative. And again, to everyone that's on the call, Freedom has been a wonderful, wonderful industry partner to FAMP. Today's webinar was free because they're one of our, again, industry and power sponsors as well. But not all webinars will be free. We have some very exciting ones coming up, two additional ones in March and also, in February. And we have the Office of Financial Regulation in March, as well as others that will be on our website. So if you are an FAMP member, we thank you. We thank you for supporting our association, your association, and your industry. And if you're not an FAMP member, please consider becoming one. You're here for a reason. We're providing wonderful resources for you through industry partners like Freedom Mortgage. So Ken, I'll see if there's any other last minute questions, and then if not, we will wrap it up for the afternoon.
I think that's it, but we certainly do want to thank you for the hospitality and for everyone's attendance today. It was a pleasure.
Absolutely. And everyone, happy Friday. Have a great weekend.
Thank you.
Oh, bye-bye.